Today we're going to continue looking at steps 8 and 9 as we close out the accounting cycle. But before we get started with that, let's just, as a reminder, look at how do we create an entry in the general journal. And we're going to use the following example. It says on January 1st, memorandum number 8 stated that Regina Delgado invested $12,000 in the business. So, what do we do here? How do we see the general journal in front of us? Let's just, as a reminder, how do we complete this? So if we remember, our first step is to enter the date, the name of the account debited, the amount of the debit, the name of the account credited, the amount of the credit, and then finally the source document. So let's look at, these are the 6 pieces of information that we need. Now where do they go and how do we position them? So the date. Okay, if it's not already on the page or if the year changes, we need to enter the year 2016 and then January 1st. Now remember, on following lines, we do not need to enter the month, January. We only need to enter the month if the month changes. So we have January 1st here, and on our first line, we have the name of our account being debited, which is cash in bank. All right, because $12,000 invested in the business, it affects the cash in bank and also the capital. So cash in bank for a debit of $12,000. The name of the account credited is Regina Delgado Capital, and that gets credited for $12,000. Remember, debits must equal credits. And then finally, our source document on the third line, memorandum number 8. So, just a reminder how to create journal entries for a transaction. Alright, so let's look at completing the accounting cycle now. Step 8 is journalizing and posting closing entries. We looked a little bit at this and the reason for doing this. And then step 9 is preparing a post-closing trial balance. And just a reminder from our last session, closing entries are the journal entries that are made to close out or reduce to zero the balances in temporary accounts, and to transfer the net income or net loss for the period to the capital account. If you remember, when we closed out step 7, the balance in our capital account does not reflect the balance on our balance sheet in the financial statements. So we need to make those line up. So first, let's look a little closer at the income summary account. What is its purpose? It's used, 1, to accumulate and summarize the revenue and expenses for the period, and it serves as a simple income statement in the ledger. So you can look at the ledger, the income summary account, and see very quickly what's our net income, what's our net loss. It's a quick summary or income statement. You'll notice if you look at the chart of accounts that the income summary account is located in the owner's equity. So it's located and tied to capital, withdrawals, and then you'll see income summary. Now it's placed here in the owner's equity because it directly affects the owner's equity. If there's a net loss, then the owner's capital account goes down. If there's a net income, then the owner's capital account goes up. So back to our accounting cycle. Step 8 is journalizing and posting closing entries. Step 9 is preparing and, sorry. Alright, how does the income summary differ from the other temporary accounts? So we talked about temporary accounts, what their purpose is, and how they differ from permanent accounts. But the income summary account is different yet. So first, it's only used at the end of the accounting period, and it's used to summarize the revenue and expense balances. Second, the income summary account does not have a normal balance side, so there's no side where we would expect to see an increase or decrease. Remember, it's a summary. Debits go, the debit column is for expenses, the credit column is for revenue. Finally, the balance before and after the closing process is 0. So when we reach step 8, the balance in the income summary account is 0. When we're done with step 8, the balance is going to be 0. So again, it's a very temporary account. And finally, it does not appear on any of the financial statements. So now that we've got the income summary sorted out, let's look at the overview of the actual closing process. So we start out by preparing our closing entries, and this really, we're going to look at 4 steps. Step 1, we're going to transfer all the revenue balances to the credit side of the income summary. So revenue goes to the credit side of the income summary. Second, we're going to transfer all the expense balances to the debit side of the income summary. So we're taking our revenue and our expenses and consolidating them into our income summary account. Our third step now is we're going to take the balance of the income summary and transfer that to the capital account. If we have a net income, it's going to go to the credit side of the capital account. If we have a net loss, it's going to go to the debit side of the capital account. Remember, if you think about our capital account, the normal balance side on the capital account was the credit side because we want to see increases. That's the normal increase side. So if we have a net income, it's going to go to the normal balance side or the increase side. A net loss is going to go to the debit side where we see decreases. Our fourth step is we will transfer the balance of withdrawals, the withdrawals account, to the debit side of capital. Remember, withdrawals is going to decrease our capital, so it goes to the debit side of capital. So let's look at each of these steps and just see an example, and we're going to use our T accounts to analyze and look at how these transactions work. So step 1, transferring all the revenue balances to the credit side of the income summary. So we look at delivery revenue, which had a credit balance, because it's revenue, of $2,650. So when we transfer that money, we're going to add our closing entry in the debit side so that delivery revenue is now 0. All right, since delivery revenue was a credit, we are going to put, and we're debiting it for $2,650, we need to add a credit entry in the income summary for $2,650. Step 2 with the expenses. Now notice expenses, we have multiple expense accounts. We have one income summary account and we have 4 different expense accounts. So what happens here is we are going to close out each of the expense accounts. We close out an expense account by putting our closing entry in the credit side. Remember, expense accounts have a balance in the debit side. So to close out an expense account, you're going to add an entry in the credit. If we add an entry in the credit to close out an expense account, then our entry in the income summary is going to be on the debit side. Now the thing that we have different here is we have 4 expense accounts that we're closing out, and on our income summary we have one entry for a closing entry of $1,500, which is the sum of all of the expense accounts balances. And we'll look at this a little bit more later, but if you remember, that is called a compound entry. Third step, we take the balance of our income summary. Now our income summary is going to have a balance either on the debit side or a credit side, depending on which side had a higher value. And we're going to transfer that to the capital account. So 2 choices. The net income is going to go to the credit side of the capital account, and net loss is going to go to the debit side. And as a reminder, you look at the income summary report, it has expenses in the debit side, revenue in the credit side. If the revenue is greater than the expenses, then the balance is a net income. If the revenue is less than the expenses, then our balance is going to be a net loss. Our final step is to transfer the balance of the withdrawals account to the debit side of capital. So here we look at our withdrawals account, a closing entry of $500, and then in our capital account we have a closing debit entry of $500. Again, remember, debits must equal credits for every transaction. So this is the preparation step. We're analyzing these 4 transactions. what needs to happen, kind of mapping things out by using our T accounts. Next, we're going to actually record those closing entries in the general journal. And this is really why we used our sponge at the beginning, just to review what does it look like. And really, the biggest difference here is that we're actually going to enter at the top of our general journal. Before we enter any of these entries, we're going to enter the words closing entries in the description column. And this just lets us know that we're closing out our accounting cycle, and all the entries that follow are the closing entries. So again, we're going to enter the date, the last day of the accounting period, and then we're going to enter the debit account and amount debited, and the credit amount account and the amount credited. Alright, so let's look at our first example here. We have closing entries. Remember, our first example, we move the revenue to the income summary. So on line 1 we have delivery revenue, line 2 we have income summary. Now notice there's no reference to a source document because these are closing entries, so that's going to be another difference. So first step, revenue to income summary. Now let's repeat the process for our expense accounts. And now here is where you often will see a compound entry, which just means that there are multiple debits or credits for a single transaction. So anytime there's multiple revenue accounts or multiple expense accounts, you're going to have in your closing entries a compound entry. Again, we have our date, and then we have our debit account, income summary, and then in the credit column we list all of the expense accounts, which should total up to equal our debit. Now our next step is to transfer the income summary to the capital. And remember, here we have two options. If the revenue is greater than expenses, we have a net income. If the revenue is less than expenses, we have a balance in the debit side, which is a net loss. So based on those two options, we're going to have two choices here. We're going to debit income summary and credit capital, as you see in the first example, or we will debit capital and credit the income summary account. Remember, debit always comes first in our journal entries, and then credit. Here's an example of our final step where we transfer the withdrawals to the capital. And here, the capital account is being debited and the withdrawals account is being credited. So let's look at the whole picture just to see what things look like when we're all done. We have the word closing entries at the top, and then we have, again, step 1, revenue to summary, to income summary. Step 2 is the income, or is the expense accounts being transferred to income summary. Step 3, we're going to transfer the income summary to the capital account. And then finally, with step 4, we will transfer the withdrawals account to the capital account. And now at this point, the capital account should be up to date. So we need to prove it. We do this by posting our closing entries and preparing a post-closing trial balance, wrapping up steps 8 and 9. So posting, we did a lot of that before, and this is identical to any other posting with one exception. In the description column, which previously we would leave blank unless we were correcting an error, we're going to write the words closing entries, or COLSENT, short for closing entry. And again, that gets written in the description line, and you can see the example there. Here we have the general ledger for capital and withdrawals. Here you see the general ledger for the income summary and the delivery revenue, again with the closing entries in place. And here we see the expense accounts with the closing entries in place. Our final step is the post-closing trial balance. And this just ensures that we didn't make any mistakes as we were recording our closing entries and posting them to the general ledger. The one difference, well, two differences between the trial balances we did previously are that the title is going to say post-closing trial balance, and In this trial balance, we only list permanent accounts. So we're not going to see the expense accounts, the revenue accounts, or any other temporary account that has a zero balance. We are only concerned with the accounts that actually have a balance, which is going to be all the permanent accounts at this point. All right, that concludes our lesson. For homework, I want you to look at the working papers for 10.6 and 10.7. If you don't have them, you can download them from Moodle. And 10.6 again and 10.7 from your textbook. Complete those and turn those in. Thank you, and we'll see you in class next time.